Everyone's staring at the Bitcoin charts, but they're missing the real story. What if the biggest crash in Bitcoin's history has nothing to do with technical analysis, and everything to do with a perfect storm that's been brewing in the shadows? It's a storm of regulatory crackdowns, soaring energy costs, and a wave of extreme fear that's about to break. In this video, we're connecting the dots before it's too late. The first pillar of this impending collapse is the one that strikes at the very heart of Bitcoin's promise: a global government crackdown. For years, the crypto world has been the Wild West, and that allowed for explosive growth. But that era is definitively over. Governments are no longer just watching from the sidelines. They are actively building the walls of their regulatory fortresses. In October 2025, the Financial Stability Board, or FSB, published a major review of how countries are implementing global crypto rules. The findings were alarming. The FSB, which coordinates financial regulation for the G20 economies, highlighted significant gaps and inconsistencies in how different countries are regulating crypto. While some, like the EU and Japan, have frameworks, many others are lagging, creating a fragmented and dangerous global landscape. Now, why does this matter? It creates a phenomenon known as regulatory arbitrage. This is where crypto companies can hop from one country to another, seeking out the weakest rules to avoid strict oversight. The FSB warns this makes coordinated supervision incredibly difficult and opens the door for systemic risk. Imagine a massive, unregulated exchange failing in a lenient jurisdiction. The shockwaves would be felt globally. Even more concerning is the lag in stablecoin regulation. These are the assets that form the plumbing of the crypto economy, and the FSB found that very few countries have any real rules in place to manage their risks, like ensuring they actually have the cash reserves they claim to possess. The message from global bodies is clear: the grace period has ended. Regulators are moving to enforce rules, close loopholes, and assert control. In the United States, enforcement actions are becoming more targeted, even as the regulatory picture shifts with new administrations. While this might target illicit activity, it signals a broader shift towards aggressive enforcement that could easily ensnare legitimate but poorly regulated players. This patchwork of rules and the threat of sudden, uncoordinated enforcement actions create a minefield for institutional investors. Big money craves certainty and stability. A world where the rules can change overnight, where a key exchange could be shut down without warning, is the exact opposite of that. This regulatory storm cloud isn't just a background risk anymore. It is an active and growing threat that is beginning to spook the very institutions that fueled Bitcoin's last bull run. The second, and perhaps most fundamental pillar of this potential collapse is a problem that has plagued Bitcoin since its inception, but has now reached a critical breaking point: its staggering energy consumption. This isn't just a talking point for environmentalists anymore. It has become a severe economic vulnerability for the entire network. Let's be clear about the scale we are talking about. As of late 2025, the Bitcoin network's estimated annual electricity consumption is often cited in the range of 140 to 160 terawatt hours. To put that into perspective, that is more energy than entire countries like Poland or Argentina. The carbon footprint is just as massive, with some estimates placing it on par with the entire country of Greece. For years, the crypto community's response was that mining would increasingly shift to renewable energy. And while there has been some progress, with some recent reports suggesting over half of the energy may now come from clean sources, the reality on the ground is far grimmer. A significant portion of the network, particularly in key U.S. mining states like Texas and Kentucky, still relies heavily on fossil fuels. Moreover, the idea that Bitcoin mining is a net positive for green energy is being challenged by recent academic studies. Some argue that it creates a more profitable alternative to investing in energy storage and grid infrastructure, which are essential for a truly sustainable energy system. But here is where the environmental problem becomes a direct threat to Bitcoin's price. The profitability of Bitcoin mining is a simple calculation: the price of Bitcoin minus the cost of the electricity needed to mine it. As global energy prices soar due to inflation, geopolitical instability, and supply chain issues, that cost is skyrocketing. This puts miners in a death grip. When energy costs rise, their profit margins get squeezed. To cover their massive operational expenses, they are forced to do the one thing that can crash the market: sell the Bitcoin they mine instead of holding it. When this happens on a large scale, it's known as minor capitulation. It creates immense selling pressure. This isn't a theoretical risk. We've seen it happen in previous bear markets, and the conditions are rapidly aligning for it to happen again. Bitcoin's energy hunger is no longer just a feature, it's a bug that has transformed into a ticking time bomb tied directly to global energy markets. The higher energy prices go, the more pressure builds on miners and the closer the network gets to a cascade of forced selling. The third pillar is the one that ties everything together and acts as the ultimate accelerant, a tidal wave of extreme fear that has completely washed over the market. In crypto, sentiment isn't just a byproduct of price action, it is a primary driver. And right now, the sentiment is pointing to a full-blown crisis of confidence. One of the most reliable barometers for this is the Crypto Fear and Greed Index, which analyzes factors like volatility, market momentum, and social media trends. On a scale of 0 to 100, anything below 25 is considered extreme fear. As of late November 2025, the index has plunged to scores as low as 11, a level of panic that suggests investors are not just worried, they are actively selling, anticipating further losses. This widespread fear is being validated and amplified by some of the most ominous technical signals in a trader's handbook. In mid-November 2025, Bitcoin confirmed a death cross on its daily chart. This occurs when the short-term 50-day moving average crosses below the long-term 200-day moving average, signaling that momentum has decisively shifted to the downside. Historically, this pattern has sometimes preceded severe bear markets, though it can also be a lagging indicator. But this time, there's a new, powerful ingredient fueling the fear: the Bitcoin ETFs. The launch of spot Bitcoin ETFs was hailed as the dawn of a new era of institutional adoption. It was supposed to bring stability. Instead, it has created a new vector for volatility. That institutional money is proving to be just as skittish as retail. In November 2025 alone, US-listed spot Bitcoin ETFs have seen a record-breaking net outflow of over $3.7 billion. BlackRock's iShares Bitcoin Trust, one of the largest of these funds, shed over $2.4 billion in that period alone. These are not small-time investors getting scared. This is institutional capital fleeing for the exits. Worse, with Bitcoin's price falling significantly from its recent highs, many investors who bought in through ETFs are now underwater, creating immense psychological pressure to sell and cut their losses. This creates a vicious cycle. ETF outflows put downward pressure on the price, which triggers more fear, which leads to more outflows. It's a self-fulfilling prophecy of collapse, driven by the very instruments that were supposed to save Bitcoin. Individually, each of these pillars, a global regulatory crackdown, unsustainable energy costs, and a wave of extreme fear, represents a serious headwind for Bitcoin. But together, they are not just headwinds, they are the ingredients of a perfect storm, creating a catastrophic feedback loop where each problem makes the others worse. Let's connect the dots. It starts with the regulators. A government or a coalition of international bodies announces a stricter framework for crypto. This news immediately injects fear, uncertainty, and doubt, FUD, into the market. This is where the second pillar, fear, kicks in. The Crypto Fear and Greed Index plunges into extreme fear. The headlines are filled with talk of crackdowns. This spooks the big money players who recently entered the market through those shiny new ETFs. They see the writing on the wall. Regulatory risk is becoming unmanageable. They begin to sell, and those once mighty ETF inflows turn into a torrent of outflows, as we've seen with billions being pulled out in a single month. This massive sell-off from institutional funds triggers a sharp price drop. Bitcoin crashes below key psychological and technical levels. confirming bearish patterns like the death cross and shattering market confidence. Now, the third pillar, the energy crisis, delivers the finishing blow. That sharp price drop, caused by regulatory FUD and ETF outflows, collides head-on with the already squeezed profit margins of Bitcoin miners who are battling soaring global energy costs. Their breaking point is breached. They are no longer mining at a profit. To cover their enormous electricity bills and stay solvent, they have no choice but to capitulate. They begin dumping their Bitcoin reserves onto an already panicked market. This is the cascade. A regulatory announcement leads to institutional fear, which leads to ETF selling, which crashes the price, which triggers miner capitulation, which crashes the price even further. Each pillar reinforces the others, creating a downward spiral that is incredibly difficult to stop. This isn't just a market correction. It is a fundamental, structural crisis where Bitcoin's core weaknesses are all being exposed at once. This is the perfect storm, and it has the potential to trigger a devastating collapse. So, what does this all mean? We've looked past the daily chart fluctuations and connected the dots between three fundamental threats: a global regulatory apparatus that is closing in, an energy consumption model that is becoming economically unsustainable, and a wave of institutional fear that is turning the ETF dream into a nightmare. Together, they form a perfect storm with the power to trigger a systemic collapse. This isn't a guarantee, of course. Bitcoin has proven resilient in the past. But this is a confluence of risks on a scale we have not seen before. These aren't just market cycles, these are foundational cracks appearing in the very pillars that hold Bitcoin up. Every investor needs to be acutely aware of the storm gathering on the horizon. Just a reminder, this analysis is for informational purposes only and is not financial advice. The crypto market is inherently volatile, and you should always do your own research. But now, I want to hear from you. What's your take? Do you see this storm brewing, or do you think Bitcoin will weather it once again? Let me know your thoughts in the comments below. And if you want to stay ahead of these market-moving trends and get analysis that cuts through the hype, make sure to subscribe and hit that notification bell. Thanks for watching.